How small apartment investors can estimate tax liability and plan strategically. Super. How small apartment investors can estimate tax liability and plan strategically. On-screen text. Title of the video. Estimate rental income and expenses. Project rental income by calculating gross rental income based on expected occupancy and rental rates. Include any additional income sources like fees for parking or laundry. Identify deductible expenses. List expenses such as repairs, insurance, property taxes, and management fees, which can be deducted from gross income to reduce taxable income. Calculate depreciation. Use straight-line depreciation. For residential properties, divide the cost basis, building value only, not land, by 27.5 years. Include this amount as a deduction each year to reduce taxable income. Evaluate cost segregation opportunities. For larger properties, consider a cost segregation study to accelerate depreciation, allowing specific assets like appliances and lighting to depreciate over shorter time frames. Apply passive activity rules. Evaluate rental income classification. Understand that rental income is typically passive, and passive losses can generally offset only passive income, not active income. This rule affects how losses can be used to reduce taxable income. Real estate professional status. For those who qualify as real estate professionals, meeting specific time and activity criteria, passive activity rules may not apply, allowing greater flexibility in using losses to offset other income. Plan for capital gains and exit strategy. Estimate capital gains tax by calculating the potential capital gains tax by estimating the difference between the property's selling price and its adjusted cost basis, which is the original cost minus depreciation. Consider 1031 exchanges. When selling a property, explore the option of a 1031 exchange, which allows for deferral of capital gains taxes if proceeds are reinvested into a like-kind property within a specific time frame. Stay informed of tax law changes, monitor legislative changes, stay updated on changes to tax rates, brackets, and laws that may impact real estate investing, changes to capital gains rates, depreciation rules, or passive income limitations can affect your tax planning approach. Consult a tax professional. Work with a tax advisor familiar with real estate investing to help structure investments and take advantage of all available tax benefits. Additional tips for tax planning and apartment investing. Maximize expense deductions. Track and categorize every deductible expense related to the property, including property management, repairs, and utilities, to lower taxable income effectively. Use qualified retirement accounts. For certain investors, investing through retirement accounts with tax advantages, like self-directed IRAs, can help defer or avoid tax liabilities. Review tax strategies annually. Tax circumstances can change year over year, so conduct an annual review to adjust strategies based on income, expenses, and changes in the law. Effective tax strategies are key to maximizing the profitability of apartment investments. By understanding tax implications, including rental income taxation, depreciation deductions, capital gains planning, and passive activity rules, small apartment investors can make informed decisions that reduce tax liability and improve cash flow. Proactive tax planning, along with insights from a qualified tax advisor, helps investors navigate complex tax regulations, optimize after-tax returns, and enhance long-term financial success.